Welcome to the Broker Playbook. I'm Coach Brandon, and if you're here, you already understand something that most people miss. In business, just like in sports, the team with the best playbook wins. Talent matters. Effort matters just as much, but knowing the plays is what puts points on the board. We created the Broker Playbook because too many brokers and investors are operating without a game plan, and they're sprinting up and down the field, hoping something works. This session, I hope, gives you structure, execution, and clarity so that you can stop guessing and start closing deals. Today we're going to focus on DSCR loans, and I'm not going to dive into the details quite yet, but we'll break those plays down throughout this webinar. And just know this about DSCRs. Okay? DSCRs put you in a position to make the plays that the other brokers can't. It opens doors that traditional lenders keep locked. And for all of you, you guys know me pretty well. I've done this for a long time, but I'm bringing in an expert today. And to help this expert is to help us learn this play. I brought in someone who knows these plays and runs them every single day. And he's the Director of Operations for Cogo Capital. Everyone at home, please help me welcome Mr. Justin Lunde.
All right, hey Brandon, how's it going?
Oh, I'm doing great. How about yourself?
Doing well. Proud, excited to be here.
Well, this is probably one of our highest attended broker webinars and most in demand all year. Mm-hmm. So you're the celebrity of the hour per se, right?
Love it. Fantastic.
So hopefully everybody at home write down his name because he's going to have a direct role in your success moving forward. Now, we brought you in specifically because you are going to have a huge role in a lot of the changes and everything Cogo Capital is making. Specifically, one of those big ones is around the DSCR loans. Right, so let's talk about just a DSCR in general. So pretend I know nothing about this. So What does DSCR stand for?
Absolutely. So good evening, good afternoon, everybody. I'm Justin Lunde, Director of Operations for Cogo Capital and Security Investment Corp. Yes, so DSCR. DSCR stands for Debt Service Coverage Loan. Basically what a debt service coverage loan is it's basically implying that the loan amount that you are receiving is less than the amount of money that you're receiving in rent. Because at the end of the day, we want to have a cash flowing property, we want to be making profit. So when we're looking at a DSCR, there's calculations that go into it. And what it's considered is PITI, and then also you can put an A at the end sometimes too. What that stands for is principal, interest, taxes, and insurance, and then the A is for association fees. That's if you have an HOA in the community where your property is. So what you're looking at is you're looking for all those figures, what they add up to, and then what you're collecting in rent. So if your mortgage is, let's say, $1,000 and you're collecting $2,000 a month in rent, that's a very well cash flowing property at a 2 DSCR.
Now, I know that you're going to talk about how all that is calculated here in just a minute, but one of the things it's been a big focus for us recently is getting this product in front of our brokers so they can help their clients close deals. And so why is that the focus right now? Why are DSCRs dominating the loan space right now?
Absolutely. If you look at the real estate environment right now, it's very much a buyer's market. It's not a seller's market because rates are high. So people are thinking, okay, rates are high, why would I want to refinance? Well, because it's not a seller's market, RTL loans or those fix and flip loans are struggling because they're having a hard time finding that end buyer. So that's why we're seeing a huge growth in DSCR loans with these higher rate environments, because right now it's a buy and hold rather than a buy and sell.
Okay. So if I understood that the economy right now is dictating that people are holding properties more than what they would have otherwise, correct?
Absolutely. Yep. With those higher rates, it's a lot better of strategy right now to buy and hold, which is why we've seen the significant growth in DSCR in the last couple of years.
Okay. And what is the most common way that people are entering into these?
The most common way we're seeing is actually BRRRRs, buy, renovate, refi, repeat. There's a lot of R's in there. BRRRR, I think. Basically what that strategy is you buy the property, you fix it up, but instead of flipping it, you refinance it into a DSCR loan at the new appraised value. So you buy it for $100,000 as is, you put $50,000 into it, say the ARV is now $300,000, you refinance it at $300,000, you take the cash out of it, and then you go buy another property and you do it again. What this is allowing people to do is they're allowed to then build a strong rental portfolio that starts to generate monthly income month over month, every single month consistently. Okay.
Great. So this is and obviously I think there's a reason why we're having this webinar, right? Is it's something that every broker should know the basics of and should have in their repertoire, right?
Absolutely.
That's the reason why we're putting so much heavy focus on it.
Absolutely.
So I know there's a lot out there. It's like, okay, they got an idea of it.
Yep.
I've got an idea. I think you've done a great job explaining the circle around it, right? So let's talk about that ratio that you were talking about earlier, right? Let's talk about how the formula breaks down.
Yes.
And for everybody at home, okay, this is now the time I want you to start taking notes so that you can, as an investor, if you're an investor or a broker, that you know how to determine if you've got a great property for a DSCR.
Absolutely. So again, DSCR,
If you need this, there's
Oh,
for everybody else at home if you need that.
perfect. Okay. Is that for that screen?
Yes.
Okay. Yep. We will go into growth trends here in a little bit. So for DSCR, when it comes to the calculation, the way how it's calculated is you're taking your net operating income and you're dividing it by your debt service. So again, your net operating income is how much you're making on the property, how much rent you're bringing in, minus any property management fees if you're working with a property management company, minus any other fees that may go into it, but most of the time it's usually that 10% off the top for property management. Then your debt service is what is your mortgage or your loan on that property. So again, that's your principal payment, your interest payment, your taxes, your insurance, and then any applicable HOAs if you live in a community that has an HOA. So what you're doing is you're basically taking, okay, I'm collecting $2,000 a month on this property after the property management fee. And let's just say again, for simple math, my mortgage is $1,000 a month all in. Principal, interest, taxes, insurance, and we'll just throw in an HOA. That gives you a very strong DSCR of 2. Now that is a very, very, very strong cash flowing property. Let's say, for instance, we go backwards. Let's say instead we're collecting $500 a month in rent, however, we're paying out $1,000 a month in our mortgage. That puts us at a 0.5 DSCR. That's not a cash flowing property. Our goal is to get into a cash flowing property, and that's one thing Cogo Capital can help with, is we can help with reversing that and getting that cash flowing.
So since you brought that up, what does that look like? How can we as a lender help an investor that has a negative cash flowing property turn that around?
So one thing that sets us apart is we can actually lend on properties that have a 0 DSCR. You could not be making any money on the property at all, but we will help structure a loan that can get you into where you will be making money. So again, if you're upside down in the DSCR, like you're at that 0.5 DSCR, we can find a way to structure a loan to be able to get you, either we can raise that rent amount, we can look at what the market rents are, or we can refinance the current loan that you're in and bring that amount down.
Okay. Well, that's good to know, and I bet everybody at home is liking what they hear there, because all too often lenders, and I know there's a lot of you at home that think this, right, that lenders are so rigid and this is what you get and anything else. What I'm hearing you say is that we are willing to help them make this work.
Correct. We're all about helping the borrower, helping the broker and their client, and our mutual client at the end of the day, right? A lot of brokers, a lot of lenders, they do require at least a 1 DSCR. They want to at least have a break-even property. But again, we go all the way down to literally nothing. We have a lot of great programs in place with Cogo Capital. We've spent a lot of time to work with a lot of different vendors, and as well as kind of alternating our different guidelines to be able to find a way to accommodate to everybody.
Okay. And when it comes to like those, you mentioned vendors, right? I'm going to kind of go off the weeds ever so slightly and opening that up, and this is kind of peeling back the curtains for everybody that's out there. Any organized lender has funding sources, right? Cogo, we have our internal funding source, and then we have external. Now this DSCR product, right? And is that more of an internal where we're funding it using our funds, or is that more external using some of these external?
That's a great question. So as of right now, Cogo has become very well connected with a lot of different vendors. So we are currently working with external funding sources for our DSCR. However, one of our big initiatives for 2026 is we want to bring DSCR in-house. What that allows us to do is have even more control over the process, which just means faster closings for yourselves and your clients.
And that's primarily a lot of your role, right? Is to figure out how to either get those funds in-house or create those other relationships, right?
Absolutely. That's why I was brought on to Cogo Capital, is to improve our processes, speed up our loan closings, and improve the client experience.
Okay. Which all of you should be applauding right now, because that's something you've been waiting on for a long time. So when I said that he's going to be very important for you to close loans, that's why, right? He was brought in for a very specific purpose. We've listened. We want to help you with the from the feedback you've given us. Now, you talked about the service ratio, right? Now, would you be able to give more of a real world example on that, on what maybe one that we've had come through recently, or one that you've personally dealt with?
Absolutely. So we've been closing more DSCR loans month over month. It's become a big priority for Cogo Capital. So we have definitely a good number of examples to choose from. We're working with an investor currently in, I believe it's either Michigan or Wisconsin. It's somewhere up in that kind of Great Lakes area. And so they came to us. They were looking for a DSCR refinance. They were at about $1,500 a month, I believe, and their rent was actually below that. So they were at a negative DSCR. We were able to get them refinanced even below their rent. So while they went from a negative DSCR, they finished around a 1.3, which is a pretty solid cash flow. So anything above 1.25, it constitutes as a pretty good cash flowing property. Your goal is to be anywhere between 1.25 and above.
And once again, to get to that point is just taking the debt of the property, putting the taxes, insurance, HOA dues on top of that and seeing where it compares to what they're bringing in from rent, correct?
Absolutely, absolutely. Yep, and even right now with where mortgage rates are with the federal funds rate, even our DSCR rates are very, very competitive.
And speaking of competitive, a lot of lenders out there have different terms that they will use, right? And for lengths of 30 years, 20 years, I've even seen some DSCRs at 10. Where do you anticipate our DSCR loan kind of sitting in for its own?
Yeah, so our average DSCR loan is 30-year fixed, very much kind of like your traditional mortgage. It's a 30-year fixed amortized loan. We do also have some other options. We have interest-only options where you can do interest-only for the first 5 or 10 years, depending on what your goal is with the property. We offer some ARMs as well. We offer a 5-to-1 ARM and a 10-to-1 ARM. We also have some prepayment penalties that you can select from, either from no prepayment penalty to a 5-year prepayment penalty. So basically nothing is holding you to that 30 years.
Okay, so they have the ability to be flexible within that, right?
Exactly.
Now, you did mention a term that some of our new investors and brokers may not be familiar with, right? ARM.
Yep.
What is that?
So an ARM is an adjustable rate mortgage. What an adjustable rate mortgage is basically they put you in a specific rate at that time, and then let's say a 5-to-1 ARM. So you're in this rate for 5 years, and then 5 years from now, the loan will automatically refinance at whatever the market rate is at that. Whatever the market rate is at that time.
Okay, so we're making it where it adjusts to the market as it's setting, right?
Correct.
So basically, it could be a 6% right now. 5 years down the road, when it hits, and rates are down at a 4%, it could drop.
Correct.
Or vice versa, it could go up, right?
It could. Yeah, there's definitely risk associated with it, and because of that, it usually allows you to get lower rates up front. So if we're right now, we started about 5.99, we could probably get less than 5.99 for an ARM. But again, you're taking on that risk of 5 years from now, you could be at 3 or you could be at 8, say. You just never know. And of course, you can always refinance again before the ARM expiration.
Yeah, I was hoping that you'd get there.
Yeah.
So if you're, as a broker, right, I've talked with in the past webinars about ways for you to be able to get more loans, work with your clients longer, and with any way that you can provide value. Right, this is one of those things. If you get them into a DSCR right now, it's on a 30-year with a 5-year ARM, right? What do we know? The rate is going to adjust, right? And it could go up, it could go down. If it's going to go down, right, or it could change, one of the best things that you can do is have a reminder on your calendar, like, hey, this loan is coming due at the ARM is getting ready to expire. We need to let's go and refinance that to get it locked in at a lower rate, and repeat. And this is one of the things I know that you've talked with people in the past is after 5 years, there's a good chance that property has a lot of equity in it, right?
Absolutely.
On a DSCR, is it possible to pull equity out of properties?
It is. Yep, you can do a DSCR cash up. So if you have equity in one of your rental properties currently, you can take cash out of that, go buy another DSCR property, and just double your cash flow.
So what you're telling me is you're not locked in, but you have the ability to be flexible.
Correct. I call it, if you understand the DSCR market well, it can be the infinite money glitch. So you can just start generating cash flow properties one on top of the other.
Okay. And so this goes into as a broker, as an investor, right? There's so many ways that you can go with these, right? Different loan products, different things, but there's some, if we're going back to the money side of things, right? There's a difference between where the funding sources come from, and there's institutional money, and then there's private money, right? And we are kind of dabbling in both, right? but a lot of the people at home may not understand the difference between what those are. Can you speak to what the differences are?
Absolutely.
When it comes to that.
Absolutely. So institutional capital, that's going to be your Wall Street money. These are your hedge funds that are basically help supplying money to private money lenders such as ourselves and helping us procure loans and originate loans that way. Private equity funding, which is something that we also offer through Secure Investment Corp. We offer a few different funds for basically real estate investing without having to own properties. But what that is that's raising money on a private level. So you're basically working with retail investors and collecting money and then using that for loan originations.
And so they obviously, there's the different styles there.
Mm-hmm.
Now, is there anything else that's unique about like the different money or the different styles of DSCRs that you can think of off the top of your head that might be interesting for an investor or a broker?
Yeah, that's a great question. Institutional capital, we're seeing a lot of interest in DSCR. I can actually show you guys here real quick. I have a great slide. So what we're seeing on industry level growth for DSCR, this is showing the share of DSCR originations throughout the entire industry. So this is including your primary mortgages, your conventionals, your FHAs, your VAs, USDAs.
So not to interrupt, but this is not just Cogo's data. This is
industry-wide.
everything.
Yep. So this is industry-wide. So we've seen over a double increase, basically over 100% increase in DSCR year over year from January of 2024 to as of last month, October 2025. So what this means is more institutional capital providers are seeing the opportunity in DSCR and they're starting to enter the space.
Okay. And for those of you that are home, here in just a second, there should be a slide popping up on your screen that you should be able to see. But it shows just a nice graph going up that is always a good thing to see for a lender. And this is where we talk about data, right? Numbers don't lie.
Correct.
And numbers can be, they say numbers can be misleading, but also at the same time, when everybody at home sees this, that's not something that you can fake, right?
Absolutely not. Nope, this is industry data straight from basically, I'm trying to remember what source I got it from. I promise you it's correct data.
Well, if you remember, I know that they would like to see it.
I will remember. I will get the data source and I'll be able to share that with you, Brandon.
Perfect. Okay. So let's kind of move on to a different section that we'd kind of talked about, and it's preparation. It's going through the loan docs, going through everything. Yep. So take us through, if we're talking Cogo Capital, we're talking a person is working with us with our processes right now. How would from start to finish, what does this look like for a broker, a borrower, as they're going through a DSCR?
Absolutely. So the first thing for brokers to identify what is your client looking for in a DSCR. Do they already have a DSCR property that they want to refinance, or are they looking to purchase a new one, or do they have a fix and flip loan that they just finished rehabbing and now they want to turn it into a DSCR and start renting out the property monthly? So what you're going to do is you're going to work with your loan officer. Your dedicated loan officer is going to provide you accurate quoting, help you find the right loan structure and the right pricing for the broker and for the client to find out what works for everybody. And then we're going to.
And I'm going to interrupt you real quick.
Absolutely.
If everybody caught it, it said dedicated loan officer. So if every single one of you should have gotten an email within the last week or so, I would believe, where every single one of you is now going, instead of having a dedicated loan analyst, we're going to pair you right with a dedicated loan officer. So we're skipping the line, having all of you skip the line per se, so that you can work with a person that can get you the answers right away and speed this process up. Because you've heard Justin say it so many times already. We're trying to speed this up. We're trying to take time off of this, right? So sorry to interrupt, but I want to make sure that I.
No, I just want to speak more to that as well. So the whole goal is, beside assigning dedicated loan officers, is exactly to speed it up, but also for the relationship factor of it. We're very big on relationships with Cogo Capital, and we like to set you up with a loan officer, and that's going to be your loan officer for as long as you work with Cogo Capital. We offer so many different products and services that we want to become a one-stop shop lender. And then we also want this individual to be there from the very beginning to the very end. So they're guiding you throughout the entire process.
So there's not going to be, I work with this loan officer for this and that loan officer for that. It's just one for everything.
Exactly. Yep. So once you have another loan, you call up your loan officer you worked with last time. You're like, hey, Robert, hey, Kira, I got this great loan. Let's get rolling.
Okay.
Yeah.
So we built the relationship. Now they're starting with the loan officer.
Absolutely.
Then what happens?
So once you're working with the loan officer, they're going to help you with all the loan quoting, get all the pricing, make sure everything's accurate. Once your client agrees to the pricing, we're going to order an appraisal. All of our loans require an appraisal. We need to go out to the property, do a full appraisal, basically evaluate the condition of the property, pull comps around the property, and just basically estimate the overall value so we know what we're lending on.
Yep. And you say comps, we're talking comparisons for the subject properties.
Yep, comparables. Right? Yep. So what we do is we look in the nearby area. We try to find as many as we can, close enough to what we can. If you have a 3-bed, 2-bath, we're not going to look at, an 8-bed, 6-bath manor, nothing like that. So.
And so touching on that, right? Because comps, that is I've talked with a lot of brokers about this. Comps can be a very confusing thing for a lot of investors, even some brokers. Are there parameters that we look for when it comes to these comps? Distance, bed, bath count. What are we looking for inside those?
Absolutely. So what we're always trying to look for, the first thing is in the immediate area. We're trying to look in the same neighborhood, in the same township, anything like that. If it's more of a rural community, sometimes we'll have to stretch out a little bit further. That can affect the overall comparison value, because if it's not quite in that same area, the other area could bring different value in one way or another, depending on the location.
And so once again, I'm kind of just building off these things, question marks, right?
Oh,
that
always.
I know a lot of brokers have brought up. This one for DSCRs, in my own personal broker business, has been brought up a lot, is you'll find the more rural properties. You mentioned rural. So that varies from lender to lender. So what is Cogo Capital's? What is your definition of a rural property?
Absolutely. So our definition of a rural property at Cogo Capital is within 20 miles of the nearest municipality. So that could just be any kind of township, city. They just need to be within 20 miles of not a super densely populated area, but just an area that has something.
Okay. And so some lenders actually have a minimum population that has to be in the area. Does Cogo have anything like that?
We do not. We do not have a minimum population density as of right now. We just go straight off of if it's within 20 miles of the municipality.
So it's distance, not population.
Correct.
Okay, great. So we're catching those comps, we're building them in, whether it's rural or anything else.
Yep.
And now we want to get that appraisal going, right?
Absolutely. Absolutely. So once we order the appraisal, the appraiser is going to come back with it. Well, first the appraiser is going to need to go out to the property. They're going to need full access inside and out. They're going to take pictures. They're going to look at nearby comps. They're going to go back to their office, prepare the appraisal report, and then they'll give that back to us. Usually the average turnaround time for a full appraisal is roughly about 2 weeks. So during that 2 weeks is a great time to be proactive with your client and start collecting documents. If it's a refinance, we want to make sure we get the lease in place. And if it is a refinance, I do want to mention there's a 6-month seasoning requirement. So we need to make sure that that lease is already active for at least 6 months. If they just re-sign their lease or something like that in the last month, we're going to ask for the prior lease as well to make sure that it was a re-sign.
And then seasoning, that's another potential gray area, right? Seasoning just means how long they've held the property.
Exactly. How long has the property been in your possession, or in this case, how long have you had a tenant in place if we're looking to do a refinance? If you're looking to do a purchase, then of course there's no seasoning requirement.
And I've actually gotten this question, so this is why I'm kind of going down the rabbit trail. Why is seasoning so important for a lender?
The seasoning is important because we want to make sure that we're lending on a property that is proven to cash flow. If you haven't gotten anybody in it, or if tenants keep coming and going, they've never stayed for 6 months or longer, that can raise a bit of a red flag. It's like, okay, why are tenants not staying for longer than 6 months, or why can you not get a tenant? That's where we will definitely work with clients on, like, okay, what are you charging for rent? See if it's in line with market rent. And if things are all aligned, but we're still not seeing the correct seasoning requirements, then that's why it's something that is a flag to us.
Gotcha. Okay, so it's a lot of it's just minimizing the risk that's involved.
It's all about risk mitigation, but at the same time too, though, we want to provide loans. We want to be able to provide loans to brokers and their clients, and we want to be able to serve them.
So we're not trying to put something in the roadblocks, because a lot of brokers, a lot of borrowers will accuse lenders of, you don't want to close my loan, you're putting roadblocks in my way. This isn't against the borrower, this is for their benefit.
Absolutely, it's for their benefit. At the end of the day, we need to protect ourselves too. We want to be here 5 years from now to continue to be a lender for them, and that's why we put those protections in place.
Now, as we kind of come back into the story of the DSCR loan, right? So at this point, we've gotten the deal, it's under contract, started the loan, appraisal's been ordered. Now we're in the document collection phase, right? What are the most important documents that investors or brokers should know about DSCR or for DSCR loans?
Absolutely. So we only lend to businesses. We're a business purpose company. So what I mean by that is entities. So we're not going to lend to an individual. We're not going to lend just to Justin Lunde. It has to be Lunde LLC, Lunde S Corp, something like that. It can be a sole prop, partnership, LLC, W Corp, S Corp, anything like that. So you want to make sure you're getting the proper entity docs for your borrower. Make sure they're all up to date. Make sure nothing is out of date. We're also going to want to see last 2 months of bank statements. Now, I do want to specify the great thing about a DSCR loan is it's not income qualified. You could not even have a job and still qualify for a DSCR loan as long as your current property is cash flowing.
So the property qualifies itself with the help of the
Exactly.
borrower.
As long as the property is going to cash flow, that's all that matters, because we're expecting the property to pay the mortgage rather than the homeowner. It's not like your primary residence where you're paying your mortgage every single month to live there. Your property is generating the income to pay the mortgage, and then you're keeping it off the top. But anyway, so we're looking for entity docs.
I'm going to interrupt one quick thing here. So we've got the entity docs, right? We're talking about this, and I'm bringing this up for everybody at home because this just happened with me this week. We're talking entities, and that you said that the property is going to pay the mortgage, right? But we still require somebody to guarantee that the loan is going to get paid, right? So even though we're lending to an entity, we still have to have a personal guarantor for the loan. Why is that so important? Why do we have to have a personal guarantor if we're going to the entity?
Absolutely. The reason why we have to have a personal guarantor on the loan is because we still go based off of personal credit when it comes to lending. We don't use business credit or anything like that. So we do require credit. That is something that factors into the lending process. While one thing that makes Cogo Capital unique is we don't have any credit score minimums for DSCR, which is pretty rare in this space. It does factor into your pricing, though.
And that's if we use just our internal funds for it, correct?
No, that is also for external as well.
Okay.
Yep. So
I just learned something myself. All right. So now that we're back into this, right? And sorry to interrupt you again.
Oh, no problem.
More questions that are popping up in my mind. All right. I'll let you continue.
Absolutely. So once we have the entity docs, last 2 months of bank statements, again, income is not a requirement, but however, we do want to try and see some reserves because we always want to, again, put ourselves in a position to, mitigate risk and protect ourselves, that we do require some reserves. It all depends on what your credit score is and any experience you might have. That depends on your reserve requirements. So I can't really speak to, we always need this amount. So we're always going to see bank statements. Big one, driver's license. We need to verify who you are. We need to do a credit and background check. We need to do a hard credit pull. So it's not a soft pull, it's a hard credit pull. So it is going to be an inquiry on your credit. So for those out there, please make sure your client's credit is unfrozen, because that is something we run into a lot.
Almost every day I hear it on the floor.
Yep, absolutely. And then also a background check. So what we're looking for on the background check is just any immediate disqualifiers. What do those immediate disqualifiers look like? If you've done a bankruptcy, you're actively in bankruptcy, that's something that would disqualify you. And then really any kind of white collar crime, like any kind of fraudulent activity or anything like that.
So we just want them to be an honest person and be able to manage funds correctly.
Exactly. We want to be working with responsible borrowers that are responsible with money.
Okay. And when it comes to so those are really all the documents that we're looking for, right?
Correct.
Now, one of the things that is a pretty common thing that we're starting to see a lot is we'll have foreign investors. I had somebody from Brussels, so over in Europe, emailed me just this morning asking if I could do a DSCR loan for them. And so foreign investors. How does that work in this scenario?
We work with foreign nationals all the time. We actually have a lot of Canadian residents that we work with. A lot of people up in Canada like to buy rental properties down in the United States and even fix and flip. So we do work with foreign nationals. They don't have quite the same credit score. I know that as well, as well as the Social Security. We have different guidelines when it comes to working with foreign nationals. I don't know them off the top of my head. However, I can definitely get them to you for distribution.
Right. And if anybody has any questions about something like that, foreign nationals, at the end of this presentation, you guys are going to have my email that you can email me questions for Justin, and you can also put questions in the chat right now so that we can answer a few of them for you here in a few minutes. So I want you guys starting to think about questions for Justin, for myself, about the DSCR loan product, or really any other loan product that we have within Cogo Capital, so you walk away from this Broker Playbook session with a full level of knowledge to go get your next deal. So we've got through the appraisal back, we've got the documents in. What's the next step?
Absolutely. So let's say we got all of our documents in, then what we're going to do is we're going to submit it to processing. So we're going to go ahead and submit that loan out to processing. They're going to go ahead and start reviewing the documents, make sure everything looks good. They're going to go ahead and work with the borrower as well as if there's any other documents they need. And if everything looks good, then we submit it to underwriting. And then once we have underwriting approval, then we just need a legal clear to close. And once we receive the clear to close, we schedule that title and everybody signs and done deal.
Okay. So pulling back, you say that everything looks good. So
Yes.
what qualifies as a looks good, right?
Exactly.
What are they looking for?
It meets all of the document standards for underwriting. We need to make sure anywhere that they require a signature is signed. We need to make sure any documents that have expirations, nothing is expired, like insurance policies, title, anything like that. Purchase and sales agreements, if you're doing a purchase, we want to make sure the purchase and sales agreement is still active and not expired, or else we need to get an update to that. So it's really, again, just being very diligent with the documents and just looking over them and making sure before you submit them, hey, this isn't expired, I need to take care of this. And being proactive and taking those steps is only going to also further speed up loan closings.
So that actually brings in, so obviously I've always referred to the processes as the pre-underwriters,
Yes.
right? They're trying to make the underwriter's job easy, catch things beforehand, and that a broker or a good investor should be like the pre-underwriter, right? They should always be looking for the red flags to get those out of the way.
Absolutely. As you're uploading documents, if you're uploading, let's say, the insurance policy that you have on the property already in place, let's say if it's a refinance, if you notice that's expired, go ahead and get in touch with your insurance agent and go ahead and get it renewed, or just get a renewed ID card, whatever you may need.
So that brings up a question. I kind of prepped you for this one earlier. So how does a broker best present the deal to Cogo? To go through.
Absolutely. So some great tips: leases. Make sure you have all the leases ready for your client. Again, this is pertaining to a refinance. If we were doing a refinance DSCR, we're going to want to see those leases, and we're going to want to see at least 6 months of seasoning requirements on those. So as you're looking at those leases with your borrower, just make sure, hey, this person's been in the property for 6 months, or if they did a lease or a recent lease renewal, then make sure we can get the old lease. Another thing I actually really want to present, because we had something come up today, make sure your entity structure, again, this goes towards mostly refinances, we want to make sure your entity structure on the original loan matches pretty close to what you're doing with your new loan. What I mean by that is we had a scenario today where it was a fix and flip loan that they were looking to refinance into a DSCR. It was a husband and wife couple, and the original entity structure only had the husband on it, and now the new entity structure has the husband and wife on it. But however, because she was not on the original entity structure, that kind of started to raise some red flags, and that was something that we need to basically get adjusted. And it's like, okay, we need to make sure the husband's on the new loan as well, because he wasn't planning on going on it. So that's just a word of advice to everybody. It's not something I would have thought of prior to today, but after seeing those entity structure differences, I definitely recommend also reviewing those.
So if you see something that's not matching up from the original to the second, ask the question.
Absolutely.
Make sure things match up.
Absolutely. Always be inquisitive, always be inquiring with your borrower, and don't be afraid to ask, like, hey, I'm seeing this, why is this? One thing I'm very big on with Cogo Capital is I believe, time is a very valuable resource. It's not something we can replace, and we want to make sure we're vetting deals as much as we can, even at the broker level, so that way you guys aren't wasting your time submitting deals that may fall apart in the end because of X, Y, Z.
So I hope everybody at home caught that, right? He said time, right? Don't want to waste time. How many times have I told you guys in past webinars that your time is your most valuable commodity, that you shouldn't be wasting it on things that are not going to produce closed loans, right? Here, Justin's really, his whole position within Cogo is to minimize the time that we're putting in it, to maximize your time and increase your bottom line, right? I want you guys thinking about that. We're taking the steps to make you more money. And if we're taking those steps, start looking at the things that you're doing, things that maybe mistakes that you're making that are costing you time that then eventually cost money. Now, you may not know what some of those mistakes are. So I'm going to ask you the next question. You probably have already know what's coming. What are the most common mistakes that you're seeing brokers or even investors make that slow down the process of getting the loan closed?
The biggest one, honestly, as simple as it is credit scores. Just be verifying with the borrower what their credit score is. If they don't know, even have them go on Credit Karma or one of those free credit reporting apps where they can go on there free of charge and get an updated score. Now, if you remember, I said we have no credit score minimums with DSCR. However, if you are below a 650, that does cap you at 50% loan to value. So that borrower is going to have to bring a significant amount of money to the table. So a lot of times we get the loan going, we pull our credit check, we find out, hey, their credit score is lower than what they stated, and now we need to update our terms, and usually their cash to close increases exponentially.
So that's one of the things that lenders do to ensure that it's a less risky loan.
Absolutely.
Is to create caps and bring more money down, right?
Absolutely, and we will lend up to 80% loan to value. Just for simple math, if you have a $100,000 property, we'll lend up to $80,000 on it. And again, just to kind of help paint the picture a little bit better, if that borrower has a below 650 credit score, they'd be looking at a $50,000 loan on the $100,000 property. Basically, they would have to bring $50,000 to closing.
And so with that having those, if you find a borrower, right, that has that low credit score, and we have to cap, this is something I know a lot of brokers are, and this might be jumping the gun for things that you've got planned in the future, so you can put me in jail if I'm letting a secret out here. Is there any way that Cogo can help in if that person doesn't have all that extra money to be able to bring in?
Absolutely. We are working on something that's coming out very, very soon to be able to have a better understanding of scores very, very early in the process. So that way we're not getting all the way to processing before we find out, what the true score was.
Right, so it's
a lot of good things coming.
Saving time by getting the scores earlier, verifying things earlier, and making sure that we're not proceeding down the road with something that somebody may not be able to afford.
Exactly, because part of providing accurate pricing is we need to know the score, and the score needs to be accurate to what we know. Sometimes we'll hear from borrowers, hey, last time I checked my credit, it was 720. Well, when was last time you checked? Oh, it was 6 months ago. We go to pull it, it comes back at a 600. That significantly impacts their pricing versus what we originally quoted them. So we're working on some new stuff. It's going to be coming out very, very soon, actually, so a lot of great things to look forward to. That part of the vetting process in the very beginning for the quoting is we're going to make sure we have accurate scores, so that way we can be like, here's your price, this is what your price is going to remain, barring anything that comes up during processing or underwriting, but credit score is not going to be a factor at that point.
Okay, great. So the eventual goal is to make it where it's not a factor, at least on this style of a loan, right?
Absolutely.
So branching into another question that's in that realm, and once again, this alludes to what we were talking about earlier about how we've seen the trend going up from 2024 until now. So let's say you've got your crystal ball because you're in the data, you're in the weeds when it comes to that. What do you see the DSCR loan product evolving to, the demand on it for 2026 and beyond?
Absolutely. So we are starting to see rates come down. I know we're predicting possibly another quarter point by the Fed in December is the kind of word that's going around. I know Jerome Powell hasn't been certain on anything yet, but that doesn't mean anything. He has a good poker face.
Very good one.
Absolutely. So lower rates just means lower DSCR rates. The DSCR rates are tied to the federal funds rate. So as we start to see rates go down, we're going to start to see DSCR rates go down. When rates go down, home values go up. So this could actually be a great time to get into a DSCR loan as those rates start to decrease. And as you start to build up equity in the next 3 to 5 years, then you can cash out, take a lot of money out of that property and go purchase another property, go purchase a fix and flip property. It's a great time to get into DSCR at the end of the day.
So when everybody should write that down. When rates go down, prices go up. And that's when you should be focusing on the DSCRs. Now that does bring in, okay, we've got a lot of new brokers that are on here that have been trained in the last recent months. We've got a lot of new investors. So if you had to name one thing, right, one actionable thing that these investors and these brokers can do to get started this week on getting and finding these DSCR deals.
A great thing would be just start looking at some local listings. A lot of strong DSCR areas we're starting to see is Southwest, Texas is really blowing up, Southeast even, kind of in the Carolinas. Start looking at some listings in that area, seeing what properties stand out to you. The great thing about DSCR is that we don't necessarily need to buy it at a significant discount because we're looking at future value. We're looking to get somebody in there as long as, again, the rent amount exceeds the loan amount. So that's another thing too, as you're looking at local listings, also be looking at what the average market rent is in that area for that type of property. 1,500 square feet, 3-bed, 2-bath. Make sure you're being that specific so that way you're getting the correct market rent. And you're basically preparing yourself for like, okay, I'm getting into this property for this today, and I almost all but guarantee that property is going to go up in value in the next 3 to 5 years because that's what we're seeing. We're still seeing a significant home shortage from the effects of COVID-19 and the various supply constraints that goes along with that. Even new builds, we're not seeing as many new builds as we used to, and population is increasing and housing is not keeping up.
So I hope you guys wrote that down. Texas, the south central side of the states, Southeast, Carolinas, great places to be looking if you're an investor for these, and great places to be marketing if you're a broker, right? Target some investors that already have these style of deals and put the bug in their ear that, hey, prices are going to be going up soon. Let's get you a DSCR to maximize that low rate, to maximize your return on the other side, right? Get that bug in their ear is going to be a great thing to go out. And he gave you, hey, that's where we're seeing a lot of our DSCR activity coming from, is those areas. Now, a big piece of advice that I've seen, and I've noticed this I've been with Cogo for, gosh, what, Peter, like 7 years, 8 years now, somewhere right around there, is every year, above the Mason-Dixon line, about this time of year, real estate investment comes to a screeching halt, right? And you've probably seen this with our loan activity coming from the northern states, right?
Absolutely.
So, but everything below the Mason-Dixon line has just drastically increases during this time of year. So if you're wondering where you should be going, just find where the imaginary Mason-Dixon line is and start marketing there, and you can't really go wrong as far as I'm concerned.
You also bring up a good point too, to not shy away from the northern states, because we're starting to see colder activity up here. People aren't thinking about being out doing real estate investing and stuff like that. They're thinking about the holidays, shopping for Christmas, getting Thanksgiving dinner ready, and they're just not as kind of thinking that way, right? So that also positions you in a great spot to make some aggressive offers, because there might be some homes sitting up north that could be a great rental property, and it's like, hey, this house is going to be sitting all winter. I'm going to hit them with a pretty aggressive offer, and you never know what you can get.
So don't shy away from it, just become more aggressive in those areas.
Absolutely. All they can do is say no.
Yeah. And I love that. I tell that to my one-on-one clients all the time, is the worst thing that they can say is no. You're still in the same position if they say no, but you're in a better position if they say yes.
Absolutely.
So I love that. All right, so we've got just a few minutes left here, and I've got our producer team back behind the camera here. You guys can't see them, but I'll tell you, in future renditions of the Broker Playbook, you'll start to get to see the faces behind the camera. But for the time being, I've got Mr. Charlie in the back, and you guys have been hopefully putting questions into the chat for him. Charlie, do we have any questions for Justin and I?
Yeah, Brandon, we've got a lot of questions. I want to let everyone know we'll probably not be able to get to all of them tonight, but we will get you answers to your questions. So hang tight. Next couple of days, we'll be going through all these and getting you guys the answers you need. Gianfranco has one, wants to know, other than principal and interest, insurance taxes, HOA, do you consider other operational expenses in the ratio calculation?
Gianfranco, that's a great question. Justin?
Not traditionally. I know there's some landlords out there that like to provide, landscaping, like mowing services, stuff like that. That's something that if you are factoring that into your rent payment, I would definitely include it. The traditional, though, is the principal, interest, taxes, insurance, and then HOA if applicable.
Okay.
All right. Iris has a question. Is there an option to have the down payment included in the loan if the property income would cover the monthly loan amount?
Ooh, you're getting creative here, Iris. I love it.
Absolutely. We love creative financing. We love creative lending. We can do gap loans, where what we do is we basically provide the down payment assistance to kind of help facilitate the original loan. When you're looking at those, you're looking at about a 65% combined loan to value. So that means the value of both loans cannot be higher than 65% of the property.
So if we're doing a gap, that means we can't go up to the 80, but we're still higher than the low 50.
We're still higher than the 50, and my recommendation is to work with your loan officer on that. They can help structure a loan that works best for them.
And it still is possible to get some of those other things with a little more creativity, but Iris, I like your thought of rolling some of those things in.
Alan has an interesting situation. He says, I'm upside down on a DSCR loan, which has a prepayment penalty. How can I refinance, take care of the penalty, put some cash in my pocket, and get this right side up?
Ooh, phenomenal question.
That's a great question. We would need to know what equity you have in the property. Hopefully you have some equity. It sounds like you're upside down in the payment. I'm not sure if you're upside down in the equity versus what you owe, or if you're upside down in the payment. It's kind of tough to know that one. I would say it's best to contact a loan officer, and they can definitely help structure that for you and find what's best.
So do me a favor, after we finish this webinar, my email will be up on the screen for you guys, and shoot me an email with your scenario. I'll get that to one of Justin's loan officers, and they can contact you and see what we can do to help you out of that.
All right. Let's see here. Next one. Evie wants to know, will Cogo still require tax documents for DSCR loans?
Nope, no tax documents. That's the great thing about DSCR. Because there's no income qualifications, you don't need to provide any tax documents. As long as the property is going to be producing enough to cover the loan payment and then some, that's all you have to worry about.
Okay. Jim would like to know, what percentage of the loan amount is the cost to get the loan?
What percentage of the loan amount is the cost to get the loan? Sorry, I'm assuming that you're probably meaning closing costs or potential down payments.
I was thinking maybe he was referring to loan to cost, which is how much of the loan will we finance with the debt. Traditionally with DSCR, we only go up to a 90% loan to cost. So that includes, basically we'll finance up to 90% of the loan, basically with the debt essentially.
So this might be a little related. Will wants to know, up to what LTV percentage can you cash out, and when can you do this?
So cash out, we can go all the way up to 75%. 80% is restricted for purchase. Probably should have mentioned that, my apologies. 75% for a refinance. You can do it at any time. Again, we just require that 6-month seasoning requirement. So as long as you've had a tenant in that property for at least 6 months, you're good to go.
Deborah has an interesting question. Will this financing work with house sharing programs?
So house sharing, meaning that they're broken up into the different rooms are cash flowing, is what I'm assuming she's talking about there.
Kind of like a multi-unit?
I'd assume.
Like co-sharing, where an investor purchases a home and then, kind of to what Brandon was saying, rents out different rooms in the house.
Oh, rents out different rooms. Yeah, no, DSCR totally works for that. What you do is you just take your combined rental income and then you put that against the loan amount to calculate your DSCR. And one thing too to mention with Cogo Capital is that we can lend and finance pretty much most DSCR properties anywhere between 1 to 4 units. Room sharing is perfectly fine. We can also do Verbo and Airbnb. That's something that not many lenders are also doing today.
I bet there's like 10 questions in there just about Airbnb and Verbos.
Susan would like to know, if I have a client with a contracted deal and suddenly his money is not available as it was, is this the right time to use DSCR? And how can I tell if it is, and how do you go about getting him started?
It depends on if he can still meet the reserve requirements. Again, I can't speak to what the reserve requirements would be because it all depends on their credit score as well as any experience that they might bring to the table. We always want to try and work with the more experienced borrowers because they're a little bit less riskier because they have a little bit more experience and knowledge in the industry. So without knowing if he can still meet the reserve requirements, it's tough to say. I would go ahead and submit your information to Brandon and I can get you in touch with a loan officer and they can help you out.
Yeah, that was going to be my scenarios. In situations like this, remember my advice is that your loan officers are your friends. Our loan officers have seen almost every loan scenario you can possibly come across, and they can tell you that second side of your question is how do you know when? That I would say reach out to your loan officer and they can tell them the exact situation. They'll tell you if that's the time or not. And over time you will figure out, you'll start to get a feel for it, and then you don't need those loan officers anymore to make that determination.
So Deborah would like to know, does the property itself have to fit the Cogo box?
It does not. So the Cogo box, I don't want it to be misinterpreted with that's all we will lend on. That's what we suggest for the best real estate investment opportunity. So it does not need to fit the Cogo box. We will go anywhere between 1 to 4 units for a DSCR. We don't have any square footage maximum requirements. A lot of that will come down to experience though. If you're looking at some of these larger properties, we're gonna wanna see a little bit more experience showing that you're experienced with handling a project such as that.
So if a person has like a 10-unit property and they've never managed more than just a single family home,
correct,
we're gonna need to see more experience or something that mitigates that risk.
Correct. You always want to be working your way up. You never want to jump straight from 1 bedroom all the way up to a 30-unit apartment complex. Say we want to be getting experience behind us. As we go, we learn. Knowledge is power, of course, right? And the more you learn, the more you can apply to your new projects down the line.
So don't jump in, wade in.
Yes, exactly.
Okay.
On that note, Miguel wants to know, what about apartment complex or an RV marina park?
So we can't do an RV or a marina park. We could potentially do an apartment complex. Again, it's going to go back to that experience factor, and I would recommend speaking with a loan officer and seeing if we can structure something.
Okay. Iris asks, can I bring more than one deal to the same agent to fund?
Absolutely. If you're looking for blanket loans, we can do portfolio or blanket loans up to 5 DSCR properties in one loan.
And Jim is asking about the 5.99% rate on the loan. What does he need to do? What are the factors that go into getting a lower rate on a DSCR?
Absolutely. So pricing is all dictated by credit score and experience. Again, income is not a requirement. It doesn't matter, how much you're making per year, how much you made last year on your taxes. All that matters is as long as the property is going to be generating, solid cash flow. That's one thing that goes into pricing as well. Anything above a 1.5 DSCR is going to qualify for that lower pricing. And then credit score, we're going to be looking at about 720 and above. And then experience, we want to see at least 2 to 3.
And so this does bring up a little bit of creative financing on the purchase side, because what I'm about to tell you really only works on the purchase. If you've got a lower credit score, let's just say 600, and you want to get that 5.99, find yourself a person to jump in on this with you that has a 750, 800 credit score with some experience. I'm pretty sure they wouldn't mind taking a little bit of portion of your profits to help you get into this and be able to achieve that low interest rate. So think about, sometimes it's not what you know or how you know it, it's who you know that can help you get those lower rates and get things locked in.
All right. Michael wants to know what kind of down is required for a DSCR loan.
Typically, it depends on the loan to value amount, so we'll go all the way up to 80%. And again, anything below 650 credit score is 50% and lower. So depending on your loan to value is what you're going to be down. So the minimum is 20% down.
Okay. Joshua would like to know how do you go from a fix and flip to a refi to a DSCR without seasoning?
Absolutely. So the way how it's considered with a refi to a DSCR, so what you're talking about is the BRRRR strategy. That's actually one great thing about the DSCR for brokers is when you're working with people that just finished a fix and flip loan looking in to get into a DSCR loan, or they want to fix and flip a property and do a DSCR at the end. That's a great thing about it is you're able to get 2 loans for one, essentially. You're getting 2 loans on one property because you're working with a borrower who's like, hey, I want to fix it up. I want to turn it into a rental. We're going to do the fix and flip loan. We're going to do the DSCR loan. So that's a great question. There are no seasoning requirements for a refinance in that instance, given that because you did the fix and flip.
So if they're the ones fixing it up and have held the property during the rehab part,
correct,
that does replace
correct
in this term.
Correct. And in the instance of a fix and flip, after 3 months of the loan being held for the fix and flip, we can then refinance it at the new ARV. So even if the project isn't completed, even if it's a 6-month project, but you've had the loan for 3 months and the projected ARV, let's say is 450, we can refinance it at the new ARV amount.
So they can potentially even pull some funds out of it while they're still even in the process.
Absolutely. And that's the great thing about the BRRRR strategy. You can pull funds out of it and then you can go buy another property and do it again.
Okay. I hope you guys are taking notes. That is a great strategy for you to be able to get more than one loan with your borrower. And for investors, if you're running out of funds on a project, maybe consider doing that.
Joshua would like to know, he's asking about, does he have to have the property under rent for 6 months first?
For a refinance, yes. So if you're looking to refinance an existing DSCR deal, then you want to have it at least under rent for 6 months, have a tenant in there for at least 6 months. For a purchase, no seasoning requirement. And then again, from refinancing from a rehab loan, also no seasoning requirement.
And James is asking a question about brokering. What kind of property should he be looking for as a broker?
So as a broker, get to know Cogo's where our sweet spots are and look for those as you're trying to find a property to broker a loan for, right? Find the investors that are focusing in on those and really go for those. And if you haven't gone through the broker certification, this is a really great way to understand. I recommend that you do, because we go through marketing and in what's called targeted marketing to a specific demographic, specific property type, specific investor type that will help you gain the lead that you're going to want to go at. But overall, if you're not wanting to focus in, just get out there and do your marketing, because if you're good with just getting your name out there, you're going to find leads that will fit within the DSCR product from Cogo and really any other lender that's out there.
Okay, guys, we got a couple more. I want to let everyone know if you have any other further questions on DSCR, we're going to drop Brandon's, there it is right now. We're dropping his email in the chat. You can hit him up. Also, if you're trying to reach out to a loan analyst that you've worked with in the past and having trouble getting through, also let Brandon know about that. We want to connect you with a loan officer to get your questions answered and get your projects moving. Mike has a question. Are DSCR loans, will they be available in South Dakota?
They are. So we lend nationwide except for Baltimore City. The reason being is we've seen a little bit of appraisal fraud activity there. So a lot of lenders have pulled back out of Baltimore City, including ourselves, but nationwide other than that.
All right, and Charlize wants to know, do we only do first position DSCR loans?
Yes, we will only lend in the first position, even with DSCR.
All right, guys.
We got a few more questions probably that are still online. Guys, continue sending those in to the email that we put on the screen for you. I want as many of those questions coming in for Justin and myself. We want to be able to answer these as they come in, so do not hesitate to communicate, right? The one question that you think is a dumb question might be the one question that prevents you from getting a loan closed, whether it's a DSCR, whether it's a fix and flip, or anything else, and that's as a broker, that's as an investor. Okay, so make sure that you are communicating. Now, I'm going to wrap up with this for everyone here. If you want some time to talk one-on-one about this, you've got questions about any other loan product, you need help with your business, okay, send an email to me and request some time. And I will make sure to schedule an appointment with either myself or one of my team members to answer those questions for you so that we can give you the most amount of education possible to help you produce the success that you're looking for. Because I'll tell you right now, Justin and I, we're counting on you guys a lot because we've got some extremely aggressive goals with Cogo Capital for next year. And the only way we're hitting them is to make sure that you guys are as educated as possible on topics like the DSCR. So for our next Broker Playbook, I'm going to let you guys know, by popular demand, last month, I had Mr. Brian Burke, one of our other coaches, on with me. Okay, and you guys wanted some more time with him, so I'm going to bring him back, and he's going to talk from a coach's perspective about what you can be doing to market your business, utilize things like Dealio Pro to generate leads, like our question was about where can I find these, right? He's going to be talking about some of those things as well. So until our next Broker Playbook, on behalf of Justin, Charlie, myself, our producers Austin and Peter, I will see you on the sidelines for our next Broker Playbook.